Good morning. As we move into the third week of March, the Goldilocks outlook we started the year with has been replaced by a much more complex reality. The primary driver: geopolitical instability. The escalation of the conflict with Iran at the end of February has sent a massive supply shock through the global economy, forcing both the Fed and American consumers to tear up their previous playbooks. Despite the turmoil, U.S. growth remains resilient but fragile. Real GDP for 2026 is still trending at a modest 2.6%, though analysts are beginning to trim those forecasts. The bigger concern is the labor market. February's employment report was a wake-up call. Payrolls fell unexpectedly, and the unemployment rate has ticked back up to 4.4%. We are seeing a stall speed in job growth as high labor costs and AI-driven automation begin to eat into entry-level roles. Inflation is back in the headlines for the wrong reasons. While we were approaching the Fed's 2% target late last year, core PCE has crept back up to 3.2%. Gasoline prices are the immediate culprit, but new tariffs and supply chain disruptions are keeping goods sector prices firm. According to the University of Michigan, consumer inflation expectations have stalled at 3.4%, ending 6 months of steady declines. All eyes are on the Federal Reserve as they prepare for their meeting this week. After cutting rates 3 times in 2025, Chair Powell and the FOMC held steady in January, at a range of 3.5% to 3.75%. The consensus: don't expect a cut this week. The Fed is in a classic bind. Supply shocks from the Middle East are lifting inflation while simultaneously curbing economic output. Cutting now risks fueling a price spiral. Hiking risks a recession. For now, higher for longer is back on the table. On Wall Street, the mood is risk-off. The Dow Jones, which crossed the 50,000 milestone earlier this year, has erased all of its 2026 gains in a sharp March sell-off. It's not just oil. We are seeing a major AI reassessment. Investors who poured billions into tech last year are now worried about disruption to traditional business models and the costs of energy needed to fuel the AI revolution. The Nasdaq remains particularly sensitive to these valuation shifts. Finally, the American household consumer sentiment hit a 2026 low this month as families feel the pinch at the pump. In the housing market, we are seeing a 2-speed recovery. While coastal prices are correcting, the Midwest remains hot due to affordability. Mortgage rates have stabilized around 5.5% to 6.0%, but a massive inventory shortage means that when a good house hits the market, overbidding is still the norm. The bottom line: the U.S. economy is navigating a storm it didn't choose. Resilience in the face of energy shocks will be the story of the spring. We'll have the Fed's official statement later this week. Stay tuned.